So how do you make this stuff work in an agricultural credit format? And I'm going to qualify all this because, again, I work in an agricultural business mindset, which is, I think, different from the way forest economists operate and look at that long-term real estate investment. And I think even from yesterday, there's a lot of opportunities for some side analyses or projects to try to figure out that interface from our experience doing annualized maple business, maple finance tracking, and then maybe the way some of those forest economists are looking at land acquisitions, equity ownership of real estate, and maybe the potential to generate some revenue or not, just kind of knowing they're holding that land for 30, 40, 50 years. But anyway, these are the ones that come up. So the 5 C's of credit for a future prospective owner, prospective borrower, right? Character, conditions, capacity, capital, and collateral. And I wanted to focus on capacity first, just to say that we work with people on, can they cash flow it? Can they make this payment? Can they come up with the annual payment amount of $15,000 a year as that example? Generally, we're doing 3-year cash flow forecasts with people. With the cash flow forecast, we're looking at conditions, right? We're trying to look at those market conditions, try to figure out what is the, when butternut releases its prices every year, can we have a sense of what the market is going to be doing for maple syrup? We've got expenses, of course, to track, and people have been hemmed up with inflation for good reason. So understanding some of those market conditions play into our forecasting to figure out, can people cash flow this thing? We certainly pull some management benchmarks into the situation. I think we've talked quite a bit about yield, or trying to make that connection between forest practice. Yesterday the conversation was, well, what if sweetness is going down after a prescription, but sap volume's going up? I think those are all the dynamics that are certainly at play to drive this cash flow forecast for debt payment. It's not a debt to asset ration. It's more debt to asset ratio. That's a typo. A healthy ration of debt. Healthy ration of debt with every business investment. But there are some indicators that we can do, and I don't want to bore you with stuff that can be found in the literature and found in a glossary, but know that there's tools out there for the business planners. Coming back to the rental thing, we mentioned yesterday, maybe 70% of the producers that own 5,000 taps or more are also renting or leasing, which giving us this clear indication that the larger operations are looking to expand, or they're needing to have business-to-business relationships, operator to landowner relationships, just in order to kind of keep their businesses going or take them to the next level. We do know from that survey work, again, economic viability can almost double once you get above 5,000 taps. And this survey we did, really, 5,000 was a really coarse cutoff because we had people from 15,000 to 20, had a few people in the 60,000 tap range. They're not all profitable, and let's just remember that. Like, you can also lose a boatload of money on a large-scale operation. And I think Mark alluded to some of the new operations that maybe come in, and then they're saying, why am I not hitting yields? Well, maybe because that initial forestry assessment or the initial work wasn't really as accurate as it could have been or should have been. Maybe the management of that maple operation isn't up to the same management benchmark that we would expect or need to run a profitable business. So there isn't, and there's never any guarantee.